Moving to the case study question, part 4 and 5 of the case study question is from financial reporting area. So it's from consolidation. Before preparing the consolidated financial statement or before answering to the question, I thought of discussing relevant theory aspect to the question. Then it's easy for you to answer to the question. Now, in the question, part 4 is relevant with the disposal scenario, right? So, Pinnacle PLC disposed one of its subsidiaries, Small Limited, on 1st January 2019, right? So, you are asked to calculate the disposal profit or loss. Now, before moving to the question, as I mentioned, let me explain the theory behind this disposal scenarios, because idea here not just to answer to the pilot paper, to look at, to gain the knowledge and to understand the relevant areas of consolidation as well. Now, if I look at disposal scenarios, there are 4 types of disposal scenarios. First one, parent is having 80% of the subsidiary and parent is disposing entire 80%. So, the parent's holding in subsidiary would be 0. This is called as actually entire disposal. Entire holding of the subsidiary is disposed. Then the second scenario is parent had 80% over the subsidiary, parent is disposing 50% of the stake of the subsidiary. So, the remaining interest of the subsidiary is 30%. Now, after disposing 50%, so this subsidiary has become an associate. Okay, you just have only 30%. You just have the significant influence when you have 30% normally. Then the third scenario is parent had 80%, parent is disposing 70% and parent is holding only 10% after the disposal, which means subsidiary has now become a normal investment. So, the share investment that has to be accounted as per SL1 financial asset. Okay, so one common feature of the first 3 scenarios is all these 3 scenarios, parent lose the control over the subsidiary. Parent lose the control over the subsidiary. So, the control is lost and accounting or the calculation of gain or loss on disposal is very similar in all these 3 situations. We will look at the format of calculating the disposal profit or loss in a little while, but it's very similar. Then the fourth scenario is parent had 80% over the subsidiary and parent is disposing 20%, and after the disposal parent is having 60% holding over the subsidiary, which means even though there is a disposal, parent still controls the subsidiary. 60% interest means parent still control the subsidiary. So, in this situation control is retained, it's not lost, and accounting for this is different from the accounting what we apply for the first 3 scenarios. Now, in your pilot paper, the question is tested in relation to the first scenario. It's an entire disposal. Pinnacle disposed entire holding of Small Limited. Now, before moving to the question, as I mentioned, discussing more about the disposal scenarios. Now, when parent entity disposes a subsidiary, parent has to first of all record the disposal transaction in the parent's individual financial statements. Parents separate financial statements. Now, in the separate financial statement, how to calculate the gain or loss on the disposal is, this is similar to a disposal of any asset, any other asset, because what you need to do is you compare, you take the sales proceed of the subsidiary disposal, how much you receive by disposing the investment in the subsidiary, and you compare that with the carrying amount, which is usually the cost of the investment. So, then you calculate the profit or loss. If the sales proceed is higher than the cost, it's a profit. If the sales proceed is lower than the cost, it's a loss. So, in all above scenarios means all these 4 scenarios. Okay, profit on disposal in the investing entities. Investing entity means, in our example, parent entities, individual financial statements are calculated like this. Now, even in the question, what Pinnacle has done was they have calculated the disposal profit of the subsidiary in their individual financial statements and it has been incorporated. Then you should understand parent not only prepare the individual financial statement or the separate financial statements, parent has to prepare the consolidated financial statements as well, including parents plus all of its subsidiaries. Now, when parent is preparing the consolidated financial statement, at the consolidation level even parent has to calculate the profit on disposal. Okay, where once the control is lost, parent has to calculate the disposal profit at the consolidated financial statement level. Now, when the parent is calculating the profit in their consolidated financial statements, what you need to understand is the date of disposal is very important. Because let's assume if the disposal of the subsidiary has happened at the middle of the year or in between the financial year, up until the date of disposal it's a subsidiary, which means when you prepare the consolidated income statement, up until that date, income and the expenses of the subsidiary to be consolidated on maybe on pro rata basis, right? Then on the date of the disposal, you need to calculate the disposal profit or loss. So when you are calculating the disposal profit or loss, again you have to recognize the sales proceed of the disposal, and you need to derecognize, you need to take out all the assets and the liabilities of the disposed subsidiary. So which means you have to take out all the net assets of the disposed subsidiary. One. Second one, you have to derecognize the goodwill figure of that disposed subsidiary. If you have a goodwill figure in relation to that subsidiary, that has to be derecognized. And also third one, if the disposed subsidiary is having a non-controlling interest, that non-controlling interest balance also you should derecognize at the date of disposal, right? So consolidate the income and the expenses of the subsidiary up until the disposal date. On disposal of subsidiary, derecognize its assets, liabilities, goodwill and non-controlling interest and calculate the profit or loss on disposal. Okay. Now, after you make the disposal, right? So I told you all, if I go back once again, if you dispose the entire holding of a subsidiary after disposal, there's nothing for you to account. But if the situation is scenario 2 or scenario 3, what will happen is after the disposal, so the subsidiary is no more there, but you have an associate in the second situation. In this one, after the disposal, you have a share investment or a financial asset that has to be accounted as per SL1 9. So what you want to do is after the disposal, this remaining interest you have to fair value on the date of disposal and thereafter apply the relevant standard for that. So if the scenario is this, so after the disposal date you account that as an associate. So normally having 20 to 50%, we believe that we have the significant influence. So you have to account as per LKS 28. Investment in associate, you have to apply the equity accounting. If the scenario is this, after the disposal, what you need to do is you have to account that as a investment, simple investment. So you have to apply SL1 9. So you might measure this equity financial asset at fair value through profit or loss or fair value through other comprehensive income, right? So what is mentioned here is recognize any remaining investment in shares of former subsidiary at fair value on the disposal date. If you have any retained investment, remaining investment, measure that at fair value and subsequently account for this under the relevant accounting standard. As I mentioned, holding of 20 to 50% is investment in an associate, which should be accounted by using the equity method. If the holding is less than 20%, it's a investment, normal investment, simple investment, trade investment. Investment should be accounted under SL1 9 financial instruments. Now the most important thing. So what I discussed up until now is up to the date where you lose the control over the subsidiary, you consolidate. You add the income and the expenses of the subsidiary, you consolidate. Then on the disposal date, you need to derecognize the net assets of the subsidiary, goodwill of the subsidiary and non-controlling interest of the subsidiary. And most important thing is on that date, by taking all these things into account, including the sales proceed, you need to calculate the disposal profit or loss in the consolidated financial statements. That is different from disposal gain or loss calculation at the separate financial statements of the parent. Right? Because in the exam what we are asked to prepare is the consolidated financial statement. So this is the format that you need to follow, or that you need to remember to calculate the profit at the consolidated financial statements, or more specifically in the consolidated income statement. Now in the question that we are going to answer, Pinnacle actually calculated the disposal profit at the parent's individual financial statements and included that in the Pinnacle's individual financial statements. So that amount of profit, what you need to do is at the consolidation level we need to take out, and the profit what you calculate by following this format you need to incorporate into the consolidated income statement. Otherwise what will happen is the profit would be double counted. Right? Now the format is, first of all you need to take the, if I take the example, if I go back again and to take an example, let's assume I am going to calculate the disposal profit for the second scenario. Parent had 80% investment in subsidiary and parent disposed 50%, and parent is now retaining only 30%. So in that scenario, if I am going to calculate the disposal profit at the consolidated financials, disposal proceeds come from 50%. Disposal proceeds come from 50%. Then fair value of the retained interest means fair value of this 30% what you retained after the disposal, because you disposed 50% and for that you receive the proceed, then you retained 30%, you take the fair value of that. Okay, you take the fair value of that, then you take the total answer. After that I told you all, at the disposal date you need to derecognize three things. First one, you need to calculate the carrying value of the subsidiary at the date of disposal. That has to be deducted. So how to calculate the carrying value of the subsidiary at the disposal date? You need to derecognize the three things what I have mentioned. First of all, net asset of the subsidiary at the date of disposal. You need to take the value of the net asset of the subsidiary at the date of disposal. Then you need to take how much of goodwill is there. That also has to be derecognized. Take the goodwill figure at the date of disposal. So what do we have here is the items which are to be derecognized. Net asset of the subsidiary at the disposal date, goodwill of the subsidiary at the disposal date, and also you need to derecognize the non-controlling interest of the subsidiary at the disposal date. So that has to be deducted. Okay, that has to be deducted. Then you take the net answer of these three, and that has to be deducted from this figure. Okay, that has to be deducted. This figure, the answer of these three, this figure has to be deducted from this. So then you are getting the profit or loss on disposal at the consolidated income statement. Okay, once we do the question, that is actually part 4 of the question. We need to calculate in Pinnacle's consolidated financial statements what is the disposal profit or loss of disposing entire holding of small limited. Okay, so the disposal date is actually 1st Jan 2019. On that date we need to calculate the disposal profit or loss at the consolidated income statement. Okay, once we do the question, we will discuss about that adjustment with the numbers. Now what I did was, I have given you an example for you to understand the entire aspect of the disposal. This is not a part of the pilot paper question, but it's a separate question for you to understand the all aspects in relevant with the disposal. Right? If I read the question, so if you look at the requirement of the question first, calculate the profit on disposal arising in the consolidated financial statements. So what is the profit or loss on disposal at the consolidated financial statement? That means consolidated income statement. Sun Limited has held 60% investment in Moon for several years, using the full goodwill method to value the non-controlling interest. So Sun Limited has 60% investment over Moon for several years, and they use full goodwill method to value the non-controlling interest. You know, to measure the non-controlling interest, you can either use the full goodwill method, that is fair value method, to measure the NCI, or else you can use the proportionate net asset method to measure the NCI, and based on that you can calculate the goodwill. In full goodwill method, you have both parent's goodwill and the NCI goodwill. In the proportionate net asset method, you just have only the parent's goodwill. You know that, right? We learned that. Now, then half of the goodwill has been impaired prior to the date of disposal. Before the disposal date, half of the goodwill which was derived is what? Already impaired. Half of the goodwill has been impaired prior to the date of disposal of shares by Sun. Details are as follows. So the details are as follows. All the figures are in thousands. Cost of the investment, that is the initial investment where Sun has made in Moon to acquire 60%, 6,000. Then Moon, that is subsidiary's fair value of net asset at acquisition. At the acquisition date, subsidiary had a net asset. Subsidiary's fair value of the net assets were 2,000. Then Moon, again subsidiary, fair value of 40% investment at the acquisition date. Which means what? Because Sun acquired 60% of Moon, that means parent has acquired 60% of the subsidiary. 40% of the subsidiary is held by the other shareholders, which means non-controlling interest. So you have been given the fair value of non-controlling interest at the acquisition date. This is for you to calculate the goodwill as well as to measure your NCI, right, which is 1,000. Then again the subsidiary net asset at the disposal date, 3,000. Okay, that is important to calculate the disposal profit we looked at earlier. Then Moon, again the subsidiary, fair value of 25% investment at the disposal date. We look at, okay, why this 25% investment fair value was given, because what is the investment made by parent in subsidiary? 60%. On the disposal date, you have been given fair value of the 25% investment at the disposal date. Then this is the point. Assuming a disposal of 35% holding for a proceed of 5 million. Now, what has happened? Parent had 60% interest over the subsidiary. Sun had 60% over Moon. Sun has disposed how much? 35% out of this 60%, which means what is the remainder? 25%. Now, subsidiary has now become an associate. Okay, you had 60%, then you disposed 35%, which means the remainder is 25%. It has to be accounted. Maybe you have the significant influence from that point, because normally having 20 to 50%, we believe that we have the significant influence. So it has to be accounted as an associate from that point onward. Now the question wants us to do a simple computation. What is it? Calculate the disposal profit in the consolidated financial statements. So let's discuss, or let's do this question in an Excel. Let's move to the numbers now. You know, you had 60% holding. Out of that, 35% was disposed and 25% was retained. So what we take first is the sales proceed of the 35%. So how much is the disposal proceed of 35% interest? I'll take that into the second column. So as per the question, it's 5 million. So in thousands, I'm doing the question in thousands, 5,000. Then I retain 25%. So I'm taking the fair value of retained interest (25% retained interest fair value), which is the final figure given in the numbers, 3,500. So then take the total of these two. So the total of these two are 8,500. Then with that, you have to compare the value of the carrying value of the subsidiary's net asset at disposal. I told you all there are three things which you need to derecognize at the rate of disposal. One is subsidiary assets and the liabilities, net assets at the disposal. You need to derecognize. Then you need to derecognize the subsidiary's goodwill at the rate of disposal. Finally, you also need to derecognize the NCI value at the disposal date. Now, first of all, I'll write less, you need to deduct carrying value of subsidiary at disposal date. Okay, so how to get the carrying value of the subsidiary at the disposal date is to find out the net balance of the three things what I have mentioned. First of all, I am taking the net asset of subsidiary at disposal date. As per the question, net asset of the subsidiary at disposal date is the fourth figure what is given in the question is 3000. I am taking that to the first column. Then I am taking the goodwill, okay, goodwill at disposal date. Okay, so the goodwill figure at the disposal date is not given. Even the acquisition date goodwill figure is not given. What is mentioned in the question is half of the goodwill is impaired. So to find out what is the impaired component of the goodwill and what is the remaining component of goodwill at the date of disposal, I have to do a working. So we will do a working. I will do working number 1 to calculate the goodwill figure, okay, at the date of disposal. So I will open up my workings here. Working number 1, goodwill at disposal date. Okay, we will take the goodwill figure at the disposal date there. So for me to calculate the goodwill at the disposal date, what I need is, I need to first of all calculate the goodwill at the acquisition date. Goodwill is calculated at the date where the subsidiary was acquired by the parent. So to calculate the goodwill at the acquisition date, I need to know the purchase consideration. So how much is the purchase consideration? That is the first figure given in the table. So the cost of investment is how much? 6000. So the I would say purchase consideration. Purchase consideration is how much? 6000. Then parent acquires 60% of the subsidiary, which means remaining 40% is held by non-controlling interest. So what is the value of the non-controlling interest? So the third figure given in the table is fair value of 40% investment at the acquisition date of Moon. Moon means subsidiary. So the fair value of NCI at acquisition is 1000. It seems that in this question you need to measure the NCI by using the fair value method. So you are taking fair value of NCI at acquisition. Fair value of NCI at acquisition is 1000. So this figure you take to the goodwill calculation, as well as this is the opening balance of the NCI at the date of acquisition. So once we are doing the NCI working, this would be the opening figure of the NCI calculation. So I am taking the total of these two. So the total of these two comes to 7000. Then to calculate the goodwill, with that I compare the fair value of the subsidiary's net assets at acquisition. As per the question, so the net asset value at the acquisition, the second figure is 2000. So fair value of subsidiary means here Moon Limited, subsidiary, fair value of subsidiary, net assets at acquisition. Fair value of subsidiary net assets at acquisition. How much? As per the question, it's 2000. Right? You actually deduct that 2000. Okay, you actually deduct that 2000 minus. So which means goodwill at acquisition comes to 7000 minus 2000 is equal to 5000. Okay, right. Then in the question it was mentioned, if you look at the second line of the first para, half of the goodwill has been impaired prior to the disposal date. That means there is a goodwill impairment. So once the goodwill is impaired, you credit the goodwill, you deduct the goodwill figure. So half means out of 5000, half comes to 2500. So you recognize the impairment figure of goodwill, you deduct the impairment figure. Impairment of goodwill 50%, which comes to actually 2500. Okay, so you deduct 2500, that means credit the goodwill 2500. Then the debit entry, you know, as the fair value method is used, credit goodwill 2500, debit entry will split 60% charges to the parent's profit or the consolidated retained earnings, and the 40% of the goodwill impairment charges to the NCI, because fair value method means you have the parent's goodwill as well as NCI goodwill in the books. So if there's a goodwill impairment, the impairment loss also you need to allocate 60% to the parent and 40% to the NCI. Right, so that means the goodwill figure on the date of disposal is 2500. Okay, 2500. This is the goodwill at disposal, and this is what we need in the question. So the working number 1, goodwill at the date of disposal, is equal to, I can give the cell reference, 2500. Okay, understood. Then I told you all you need to derecognize 3 things. One is you need to derecognize the net asset value of the subsidiary at disposal, which is 3000. You need to derecognize the goodwill figure of the subsidiary at disposal, which is 2500. Also, you need to derecognize the non-controlling interest figure at the date of disposal, which means if parent had 60% holding, NCI had how much? 40%. You need to calculate what is the 40% NCI value at the date of disposal. That also you need to derecognize. So that has to be actually deducted from this answer. Less, you need to deduct NCI at disposal date. NCI at disposal date, because NCI is a credit balance. Net asset and the goodwill are debit balance. So these debit balances we are taking as plus figures, 3000 and 2500. Okay, net assets means assets minus the liabilities. It's a net balance is a debit balance. Then the goodwill is a debit balance. You take that as plus. But NCI, you know, it's a credit balance. That's why we deduct here. Okay, you deduct the NCI at the disposal. Again, in the question, NCI at the disposal is not given. If it is not given, we don't need to worry. We can do a working and calculate that number. Working number 2. I am doing a working number 2 to calculate the NCI at the disposal date. Here I can say my working number 2, NCI at disposal date. NCI at disposal date. So the NCI calculation is started from the acquisition date. We looked at earlier here, at the acquisition date, for the goodwill calculation we have taken the fair value of NCI, which is how much? 1000. So the double entry of this 1000 is actually debit 1000 to the goodwill calculation, initial NCI value, initial 40% value at the date of acquisition, credit that to the NCI. So credit means this is the initial value of the initial figure of the NCI working. You can say fair value of NCI at acquisition. Fair value of NCI at acquisition. This 1000. Okay, 1000. So same figure. Then what will happen is, from the date of acquisition to the disposal date, you need to look at what is the increase in the subsidiary's net assets. Now if you look at the question, the second figure says acquisition date fair value of the net asset of the subsidiary is 2000. Then the fourth figure says net asset of the subsidiary at the disposal date is 3000. That means from acquisition date to the disposal date, net asset of the subsidiary has increased from 2000 to 3000. So what is the change? 1000. Out of that net asset increase of the subsidiary, up until the date of disposal, parent held 60% and NCI held 40%. So that means out of this net asset increase from the acquisition date to the disposal date, 60% belongs to the parent company, that has to go to the consolidated retained earnings, okay, and 40% has to be taken to the non-controlling interest. So the after taking the fair value of NCI at acquisition, then I am taking the post acquisition net assets belong to the NCI. So how do I take that is, so how do I calculate the post acquisition net asset? So the disposal date net asset value is 3000, acquisition date net asset value of the subsidiary was 2000. So you take the post acquisition as 1000, 3000 minus 2000, that into what percentage? 40% belongs to NCI, post acquisition. Okay, post acquisition net assets, I would say, post acquisition net assets. So 1000, 3000 minus 2000, 1000 into 40%. So that comes to how much? If I do the calculation here, 3000 minus 2000 into 40%, 400. So the post acquisition net asset belongs to NCI, 400. In addition to that, hope you remember there was a goodwill impairment. So when there is a goodwill impairment, I told you all, you need to be careful, because if the NCI is measured by using the fair value method, within the goodwill you have the parent's goodwill as well as NCI goodwill. Now here, when there is a goodwill impairment, 2500 credit goodwill, out of that you charge 60% to the parent, 40% to whom? Non-controlling interest. But if the NCI is measured by using the proportionate net asset method, if the NCI is measured by using the proportionate net asset method, that means within the goodwill what you have is only the parent's goodwill. If there is a goodwill impairment in such situation, entire goodwill impairment you charge to the parent's profit, consolidated retained earnings, no charge to the NCI. But as the fair value method is used, 40% of the goodwill impairment you need to charge to the NCI. Okay, I would say impairment of goodwill, total goodwill impairment is 2500. Out of that, how much to the NCI? 40%. Okay, that means from this figure, so the impairment of goodwill 2500 is the total figure. Out of that, how much? 40%. So it has to be debited to the NCI. Debited to the NCI means NCI is a credit balance. Debit means what? It is a minus figure. So you say 2500 into 40%. You have to deduct that from the NCI. Then after deducting the goodwill impairment, so the final NCI value at the date of disposal will be 400. So this is the NCI figure at the date of disposal, and that is the answer of working number 2. I can take that here. So it has to be deducted. Remember, NCI value has to be deducted here, is equal to minus 400. Okay, you de-recognize the net assets of the subsidiary at date of disposal, you de-recognize the goodwill at the date of disposal, you de-recognize the NCI at the date of disposal. Then you take the net figure of these three numbers. What is the net figure of these three numbers? I can take that here, 3000 plus 2500 minus 400, 5100. Take that as a negative number. Take that as a negative number. So that is 3000 plus 2500 minus 400. So 5100, that has to be deducted from 8500 to calculate the profit on disposal at the consolidated financial statement. So more specifically in the consolidated income statement, I would say profit on disposal. It's a profit because why? 8500 minus 5100. 8500 minus 5100. So what is the profit? 3400. So this 3400 profit you need to recognize at the date of disposal on the consolidated income statement. Then if I go one step forward, so the after disposing you had 60%, you disposed 35%, then the remaining shareholding is 25%. After the disposal date, this remaining 25% shareholding you need to account as a associate. Okay, because normally we believe if you have 20 to 50% holding, you have the significant influence, so you have to account that as an associate, where you need to follow the equity accounting method. So this is the answer to that question what I have included in the slide. Next main adjustment what is tested in the consolidation question is step acquisition. Okay, here I have given an example where the investor, right, acquire initially on 31st December 2017 25% holding over the investee. At that time investee is not achieving the control, so maybe investee is gaining the significant influence. Thereafter after some time, 30th September 2019, investor acquire another 35%. Now altogether 60%. So the scenario is where the investor achieve the control over an investee, not in single block of share purchase, by series of share purchases or stages. Okay. Now step acquisition occurs when parent company acquire the control over the subsidiary in stages. Now once investor achieve 60%, you can consider investor as the parent, investee as the subsidiary. So the step acquisition means step acquisition occurs when the parent company acquire the control over a subsidiary in stages. This is achieved by buying blocks of shares at different times, series of share purchases. Okay. But what you should understand is, if I ask you the question, when we should apply the acquisition accounting? Can I apply the acquisition accounting here? No. Acquisition accounting should be applied only after parent gain the control over the subsidiary or the investor gain the control over the investee. So what is the date where the control was taken? Only on 30th September 2019. So the acquisition accounting should be applied only after investor achieve the control or the parent achieve the control. So the acquisition accounting means you can start doing the consolidation, simple as that. So the acquisition accounting is only applied at the date when control is achieved. In my example, it is on 30th September 2019. Now the next question is, up until you achieve the control, how are we going to account the previously held equity interest? Now in my example, investor had 25%, previously held equity interest. How are you going to account for that? So you apply the relevant standard, that's it. So if it is a normal or a simple investment where the holding is, let's say, less than 20%, maybe 10%, you account the previous investment under SL1 9, equity financial asset. Either you measure that as fair value through profit or loss equity financial asset, or a fair value through other comprehensive income equity financial asset. If you have the significant influence, in my example, so the investor had 25%. So that means investor has significant influence over the investee. So up until you achieve the control, you account that as a what? Associate under LKS 28. Or else, if the investor has the joint control over the investee with another venturer, you account the previously held investment as a joint venture, right? Or else, if the previously held interest is a joint operation means you don't have a separate entity, it's an operation only. It has to be accounted under what? SLFRS 11. So SLFRS 11 in the case of a joint arrangement other than a joint venture. Joint arrangement other than a joint venture means what? Joint operation. So you apply the relevant standard before you achieve the control. Okay, accounting for any pre-existing equity interest of the entity, apply SLFRS 9 in case of a simple investment, apply LKS 28 in case of an associate or a joint venture. So you have to equity account. LKS 28 says that if it is an associate, if it is a joint venture, you have to equity account for that. Apply SLFRS 11 in case of a joint arrangement other than a joint venture, that means if it is a joint operation. Then the most important thing is, I told you all, at the date where you achieve the control over the investee, you have to apply the acquisition accounting. You have to apply the acquisition accounting, which means you should start the consolidation. But before starting the consolidation, you have to follow certain steps. Accounting at the date equity interest is increased and control is achieved. First thing that you need to do is, previously held equity interest, you should fair value. Now in our example, investor had 25% previous holding, that has to be fair valued. Okay, and this, so once you fair value, what will happen is there will be a difference between the existing carrying value and the fair value of this previously held equity investment. So that gain or loss of this fair valuation of previously held equity interest, you take to the profit or loss of the year. When you prepare the consolidated income statement, that has to be taken to the consolidated income statement as a profit or loss, the gain or loss of this fair valuation of previously held equity investment. And also I told you all, once you achieve the control, you should start acquisition accounting, which means you should start consolidation. So on that date you need to calculate the goodwill, most important adjustment in consolidation, plus you should recognize the non-controlling interest for the first time. Right, moving on. Then how to calculate the goodwill? So in a step equation, because why I include the calculation here is it's little different from a normal goodwill calculation because control is achieved in stages. So going back to my example, this particular example, remember this, 31st December 2017 you achieve or invest acquire 25%, 30th September 2019 invest acquire another 35%. So keep this example in mind when we look at the format of calculating the goodwill. Okay, so this is how you calculate the goodwill in a step equation. We will discuss the computation once we go through the question, because in this scenario actually Pinnacle acquire the control over Teak PLC in stages. It's a step equation. So we will look at the numbers once we actually do the question. By the time being, this is how you calculate the goodwill in a step equation. You first of all take fair value of the previously held interest. That means in our example, fair value of the 25% interest. Okay, previously held equity interest fair value. Then fair value of the consideration for the additional interest on the date where you achieve the control. In our example 30th September 2019, what is the fair value that you pay to acquire the additional interest? That means to acquire 35%, how much you have paid. That is the amount of the purchase consideration paid on 30th September 2019, that is equal to the fair value on that date. Now 25% fair value here, to acquire 35% how much you have paid is here. Then you take for the goodwill calculation 40% of NCI, 40% of NCI. You take NCI at acquisition. So the NCI can be measured either by using the fair value method or the proportionate net asset method. You have to always follow the examiner's instructions. In this question, your pilot paper question, it is measured by using the fair value. So you need to take the fair value of NCI or proportionate net asset basis the proportionate value of the NCI. You take the total, out of that total you deduct the fair value of net assets at acquisition. So at the date where you apply the acquisition accounting, in our example 30th September 2019, what is the fair value of the subsidiaries net assets? You deduct that and you derive the goodwill figure at the date of acquisition. So the last point I want to mention is, in this question there is an adjustment relating to LKS 27, separate financial statement. So if I give you the background, you know, like when parent company prepare their individual financial statements. So the parent company has to account this investment in subsidiaries, associates and the joint ventures, right? So in the parent's consolidated financial statements, parent consolidate the subsidiary, parent equity account the associates, parent equity accounts the joint ventures. That is the accounting treatment at the consolidated financial statement level. What I am telling is, in the individual or the separate financial statement of the parent, how are we going to account the investment in subsidiaries, associates and the joint ventures? What the standard says is, standard has given a choice to the entity. Entity can follow one of the three methods what is mentioned in this slide, which means entity can either account the investment in subsidiaries, associates and the joint ventures in separate financial statements at cost, or else in accordance with SL1 9 financial instrument standard, which means you have to fair value, and the fair value changes you can recognize either through fair value through P&L or fair value through OCI, okay, fair value through other comprehensive income. You can apply SL1 9, or else in the individual financial statements of the parent can account the investment in subsidiary, associate or a joint venture by using the equity method. Now in the question, Pinnacle PLC is the parent company. So what Pinnacle PLC has followed is the second choice. But normally you should understand, normally what will happen is companies are taking the first selection or the first choice because that's easy and also it's less work. But here the Pinnacle PLC has used the second method where they account the investment in subsidiaries as per SL1 9. They fair value the subsidiaries investment in the individual financials, and these fair value gains and losses are taken to the other comprehensive income, right? So applies LKS 27, separate financial statements, applies when an entity has interest in subsidiaries, joint ventures or associates, and prepare separate financial statements. In separate financial statements, investment can be accounted at cost or in accordance with SL1 9 financial instrument standard, or else by using the equity method. Right. Then what is the impact when you prepare the consolidated financial statements now? Now when you prepare the consolidated financial statements, when you gain the control over a subsidiary, you have to calculate the goodwill on the date where the control is achieved, which means for the purpose of consolidation, for the purpose of goodwill calculation, what you need to take as the investment is the purchase consideration fair value at the date of acquisition, not at the reporting date. So which is normally equal to the what? Cost of the investment. Now what happens is, if the Pinnacle PLC applies the second choice, or if they fair value the investment in subsidiary at the end of the each reporting period, so the reported figure as the investment in subsidiary you can't directly take into the consolidation, directly take into the goodwill calculation, because for the goodwill calculation what you need to take is the acquisition date fair value. But in the Pinnacle PLC's individual financial statements with regard to the investment, what you have is the reporting date fair value. So the acquisition date fair value normally equal to the cost of the investment. Again, in the when I'm discussing the question, I will discuss with the numbers in detail about this adjustment, but keep in mind these are important adjustment where you should understand and correctly adjusted in the consolidated financial statements. So what we can do is the question. So now we are moving to the main part of the discussion, that is to actually prepare the consolidated income statement and the consolidated statement of financial position, which I will do in an Excel.